Let's go. All right. So looking into accounting for materials here, let's get a good understanding about it. We have two quick topics here, something that we've already done yesterday. सबसे पहले is what is inventory control. Second, why is inventory held? These are two topics that we touched upon yesterday. Then objectives of inventory control. Then why do you generally need a good inventory management system? And how does managing inventory really help the business? So let's look into this. Firstly, what is inventory control? And just to understand every bit of it in a simplistic sense, that's firstly, inventory control ensures that the right materials are purchased, stored, and issued and paid for efficiently, while there is no wastage, there is no theft, and there is no production delays. Okay, what is inventory control? It's making sure the right materials are bought, right materials are stored, right materials are issued, right materials are paid for. There is no waste, no theft, no production delays. That is the meaning of inventory control. Next, we look into why do we hold inventory? To ensure there is a smooth production. The factory doesn't stop due to raw material problem. Meet unexpected demand. If suddenly sales go up, you have the stock, get bulk discounts, benefit from price changes, and maturation needed. Some inventories need maturity with time, like wine and cheese and tobacco. So for those reasons, you need a good inventory management system. Next, we looked into what are the objectives of inventory control. What are certain objectives? Firstly, the objective is to meet any unexpected demand. Second, obtain bulk discount whenever possible, benefit from price fluctuation, then prevent production stoppage and meet technical requirements. Right? For these reasons, oftentimes we may need inventory control. Next, we look into some control over purchases. When we talk about control over purchases, what about the control over purchases? Here again, a very introductory topic. What are some controls that need to be there over purchases? Firstly, purchase only the necessary items. Stop overbuying. Purchase only items that are necessary. Second, you should have proper authorization. Only authorized staff can approve the purchases. Not everyone can approve it also, and you need authorization. Next, buy only from genuine and approved suppliers. Next, match the goods received with the order. Right? Confirm the quantity and the quality. Next, verify the purchase price. Make sure the supplier charged the agreed price. Make sure the supplier has charged the agreed price. Next, have proper documentation. Keep records so that we can audit and prevent any fraud and errors. So these are the importance of controls. Firstly, purchase only the items that are necessary. Have proper authorization. Buy from approved suppliers. Confirm the correct quantity and quality. Verify the purchase price. Ensure the supplier charges the agreed price, not extra. Proper documentation. Create an audit trail and prevent fraud and errors. Create audit trail and prevent the fraud and errors. Create an audit trail and prevent the fraud and errors. Create an audit trail and prevent the fraud and errors. Next, we look into the inventory purchasing process. What about the inventory purchasing process? And how do we go about purchasing the inventory? Here we have the whole process right down right here. So we have some documents that we look into. So firstly, we'll start with the material requisition. These are documents that we looked into yesterday quickly. So firstly is material requisition. So this is issued by the production department to the stores department requesting some material from the stores. Next, purchase requisition. This is from the stores department over here requesting purchasing to buy the materials to the purchasing department. Purchase order. This is sent by the purchasing department to the external supplier to order the goods. Delivery note sent by the external supplier to the storage department along with the goods that are delivered. Supplier invoice sent by the supplier to the purchasing department requesting payment. Quotation also sent by the supplier to often the purchasing department when we are inquiring about what products they have and at what price. Material return note. So if the production department has anything extra, they want to return it back, or anything that is faulty, they issue a material return note. Production return note, goods return note. This goes from the stores department to the external supplier, and in exchange of that, the supplier gives us a credit note which we can use later on. Okay, then we looked into certain important departments here. What are those important departments that we are looking into? Is production department, stores department, purchasing departments, and the accounts department. So these are some 4 departments that are very important that we'll look into here. Is making sure that the production, stores, purchasing, and account department, we are clear with this. Production is basically the factory, store is basically the warehouse, purchasing is the team that makes all the purchases, accounts is basically a team where it verifies the invoices and makes the payment. Okay, verifies the invoices and makes the payment. Okay, so this I think we don't need, it's a repetition. Next, look into computerized controls here. Let's get a strong understanding about that. What about computerized controls? Let's look into this. What do we have in store with regards to computerized controls here? We look at documents, all done well. Now coming to the computerized department. What about the computerized inventory controls and systems? So we have a simplified study here, which will really help us quickly get an understanding about all the points here. We have the disadvantages and the disadvantages as well. So it's a comparative table. In this format, if we study, it will feel very easy from here. Now this is done. Computerized inventory system, simplified notes. Now looking into the computerized inventory system. What about these systems here? So this helps take a broad view. Looking into the computerized inventory system, extranet, TPS, and MIS. These are some of the things that we'll quickly look into and get a good understanding about these. Firstly, we'll look into computerized inventory control system. Right. In this case, what happens is it tracks the stock levels and auto places new orders. Whenever it is low, it will automatically place the new orders. It is mainly used by large businesses. Small ones may still use paper. Large businesses will use this. Advantage is it's fast, accurate, and real-time control. And disadvantage is high setup and maintenance cost. Disadvantage is high setup and maintenance cost. So firstly, we looked into computerized inventory control. It will track your stock levels and automatically place the order whenever your inventory is low. Large businesses will use it, small may not. Advantages is fast, accurate, real-time control. Disadvantages, there's high setup and maintenance cost. Disadvantages, there's high setup and maintenance cost. Next, we look into the extranet. It's a private secure network. It's only let certain select group of people to access the company's data. It's mainly for inventory sharing, order processing, giving a product catalog to people. It leads to better communication and fast orders. It leads to better communication and fast orders. It improves their efficiency as well. And finally, the disadvantage is it's expensive plus security risk if the data leaks. If the data is leaking, there's a security risk, there's a better communication, there's a faster order, and it improve the efficiency. Next, inventory sharing, order processing, and product catalog. Inventory sharing, order processing, and product catalog. That is the main use of it. Inventory sharing, order processing, and product catalog. It's just a private secure network where only a select group of outside people get access to the company's data. Mainly used for inventory sharing, order processing, product catalog, better communication, faster orders, and it improves their efficiency. It's expensive if the plus it's expensive plus there's a security risk if the data leaks. Right? There's a security risk. If the data leaks, there will be a security risks. Next, we look into transaction processing system. This is your records your daily business transaction. Automatically, it will record a daily business transaction automatically. Mainly used by operational managers, sales, purchase, payroll, production. Everyone uses it. Next, fast production plus accurate records. It's the base for other reports. It helps in fast processing. It maintains your accurate record and it is a base for all the other records that you will make in the future. Right? The problem over here is if you put wrong data, the report will be wrong. So it's very important that you should put the right data. Right? If you put the wrong data, if you put bad fruits, the juice will automatically be bad. So similarly over here, if you put the wrong data, then your report will also be wrong. It really helps in fast processing. It keeps everything so accurate and this is the base for all the other reports. Right. Key points over here. It's mainly used by operational managers, sales, purchase, payroll, productions, and it records your day-to-day transactions. Automatically, it records your day-to-day transaction. That is the best thing here. Next, talking about a management information system, it converts your TPS, your transaction process data, into summary reports for decisions. The MIS converts the TPS into summary reports. MIS converts the TPS. TPS is basically a complete set of information. MIS is a summarized version for decisions. It's mainly used by middle managers because they have to make the major allocation decision. So it mainly used by middle managers. It helps to monitor the performance and also to support the decision making. Helps to monitor the performance and also the support decision making. And mainly here the focus is internal only. Right, the main focus is internal only. Right, it has the limited analytical capability compared to advanced systems. MIS, there are way more advanced systems, so this has some kind of a capability issue. Right? They don't have all the capabilities. So we understood mainly what it does. Take TPS, convert it to some summarized version of decision making, mainly used by middle managers. It's used to monitor the performance, and mainly it is internal focus. Mainly it is internal focus. Okay, it has very limited analytical capability compared to advanced systems, and mainly the focus is internal. Mainly here the focus is internal. It converts TPS into summary reports for managers, mainly used by middle managers. It helps to monitor the performance. Mainly the focus is internal here. It has very limited analytical capabilities. It has a very limited analytical capabilities, and compared to advanced system, it's not has that much analytical capabilities. So we looked into the extranet here, a little bit more on the extranet before we go into TPS in detail. So when we talk about extranet is a group or it is an information for a extranet. If we talk about extranet, is just basically a private network where a private network right a private secure network to share company information to outsiders. It's a private secure private network to share company information with outsiders. Right, it's a private network to share company information with outsiders. What is the purpose of this? The purpose of this to securely share the information with the supplier, customer, and partner. It's a company portal where some select people externally also have the access. Not everybody, but select group like customer, supplier, partners. They are external to the company, but they still have access. So to kind of share information with them, and main users are suppliers, vendors, distributor, authorized customers. Okay, what does it help in? Inventory sharing, e-commerce integration, and supplier communication. Inventory sharing, e-commerce integration, and supplier communication. What are the advantages? Faster communication, better supply chain, exclusive product catalogs. Faster communication, better supply chain, exclusive product catalogs. What are the disadvantages? It's costly to set up and cyber security risk. What is the disadvantage? It is costly to set up and cyber security risk. It is costly to set up, plus cyber security risk is there. It is costly to set up, and there's some cyber security risk also. It is faster, better supply chain, better communication, exclusive. You can share the catalogs, right? Mainly used for inventory sharing, e-commerce, integration, supplier communication, right? You can do all that examples. And a lot of people use it like supplier, vendor, distributor, authorized customers can use it. And it's mainly secure shares info. It securely shares information, right? It makes sure that it securely shares the information. That is the biggest benefit of extranet. Now let's look into the TPS, which we already looked into. It's used your daily operations. It is used by the operational managers at the lower level managers. They in detail information is over here. Main function is to capture, to process, store the output transaction data, to keep a store of everything. Main goal is to keep a store of everything. Example is sales system, purchase ledger, payroll, and production system. Sales system, purchase ledger, payroll, and production system. That is the main example here. Sales system, purchase ledger, payroll, and production system. Sales system, purchase ledger, payroll, and production system. That is the main example. Output, daily transaction reports and summaries. So there will be daily transaction reports, daily summaries. That is the output over here. Daily transaction report and daily summaries. Right? It makes sure that all the information is recorded over here, and it keeps a major record of everything. That is the biggest benefit over here. Risk, however, is that if you put incorrect data, then the report is also incorrect. So if you bad fruits is bad juice. So similarly, if you put incorrect data, your report is also incorrect. Mainly used by operational managers. Main function is capture, process, store, and the output. Capture, process, store, output transaction data. Example is sales system, purchase ledger, payroll, production. Output daily transaction reports and summaries. Risk is incorrect data results in incorrect reports and poor decisions. Incorrect data results in incorrect report and poor decisions. Incorrect data results in incorrect reports and poor decisions. The incorrect data, if you put, then there is no point of having such a good system also, because incorrect data will lead to an incorrect report. MIS over here converts the operational data into management reports. It converts operational data into management reports, mainly used by middle management. Main function is planning, performance, monitoring. Right, mainly the data comes from TPS. So they take the TPS, make a summarized version of it, make an analysis, and make decisions. Right, the reports produced: sales reports, customer analysis report, inventory aging reports, production summaries. Right, and it can access detailed transaction information when required. So whenever required, you can get detailed information also from the TPS. But mainly this uses summarized information. Right, mainly this uses summarized information. Okay, now we'll just finally look into the same topics just from a comparative perspective here. It records the transaction, it summarizes the informational, mainly used by operational managers, middle managers. It has detailed data, it has summarized data. It is used for routine operational part, it's used for planning and controlling. It's made here only periodic basis it will be made. Mainly used by payroll, sales, ledger. Here they do use for analysis, inventory aging reports, performance reports. So these are some of the topics. Now looking into inventory holding here, what about that? Let's get a strong understanding about the same. P is done, MIS is done. Features we have differentiated. Now like to into inventory holding and ordering cost, type of inventory cost and everything around the same. So whenever we talk about inventory, inventory means stock. What is inventory? Inventory basically means stock. Stock anyone sells to make revenue and ultimately to make profit. So that is the meaning of inventory. So even if we have inventory, there are various costs related to inventory. First is buying inventory. If I sell watermelon, I have to first buy the watermelon from the farmer. So first is the cost of buying the inventory. Once you have bought the inventory, you have to store it in your godown. So there's a cost of holding inventory. Next, while you order the inventory, you have to incur some cost because you'll be ordering the inventory. You may have to incur some cost. So that is ordering cost. Right? That is ordering cost. Next is stock out cost when the inventory is unavailable. What is stock out cost when the inventory is unavailable? Now you have to tell no to your customer. You have to tell no to your customer is going, so that is the stock out cost. Then we have inventory recording cost, the cost of maintaining inventory records. You need someone in admin department to record everything also. So there are multiple costs. One is purchase cost. I bought the watermelon, purchase. Second, I have to store the watermelons to warehouse cost. Next, when I was ordering the watermelon, if I went and I bought, that is one thing. Then also petrol cost was there. Or if I ordered, then I have to pay some ordering cost also. There will be a delivery person who will deliver it. So again, ordering cost is there. Stock out. If the customer came to my shop, I don't have any watermelon, then he went, that money I could have earned. It's a cost for me because that money came and went off. Then inventory recording cost. I need someone to keep proper books of accounts. How many watermelons I bought, how many watermelons I sold, and a clear understanding of everything. So purchase cost, buying it, holding cost, or storing it, ordering cost. We are placing an order, stock out cost when the inventory is unavailable, inventory recording cost of maintaining your inventory records. Cost of maintaining your inventory records. Inventory recording cost is the cost of maintaining your inventory. Cost of maintaining your inventory records. Very important. Cost of maintaining inventory. The cost of maintaining inventory. Next, we'll look into is holding cost. What about holding cost? Specifically, when we drill down into holding cost, first is the money blocked in stock, can't use it for other businesses or cannot be used for anything else. The holding cost is basically when you store everything, you have to pay money for that also. You need a storehouse, you need a warehouse, you need a storeroom, you need temperature control, you need someone to keep a check on it. So it takes money. Even holding inventory is not free. Just buying and keeping it where? Even keeping it will cost you some money. Right. Next is you will get an insurance for some of the inventories. They get an insurance, so you have to pay the insurance premium. That is another cost. Then your inventory will get deteriorated. As if you are unable to sell, it keeps deteriorating over time. If you're unable to sell, it keeps deteriorating over time. Next, obsolescence. Right, items become outdated. Right, your items inventory becomes outdated. Obsolescence, your inventory becomes outdated. Your inventory becomes outdated. Next, damage and pilferage. That there's a loss due to breakage or theft. There is a loss due to breakage and there's a loss due to theft. Loss due to breakage and loss due to theft. That is damage and pilferage. Next, warehouse upkeep. Rent, electricity, maintenance of godown. Rent, electricity, and maintenance of godown. Again, for that also you need a guy, right, who will sit and do everything. So rent, electricity, and maintenance. Next, stores labor. So you have to pay the salary of staff and managing the warehouse also. Stores labor. You need a salary of staff and managing the warehouse. You have to pay the salary of the staff to manage the warehouse also. Warehouse upkeep, rent, electricity, maintenance of the warehouse. There will be theft or damage. That is again a loss. Inventory becomes outdated because new inventory has come. This happens in fashion. Deterioration. With time, inventory loses the quality. Insurance, you'll have to pay for the insurance as well. And opportunity cost, money is tied up in inventory, you cannot use that money anywhere else because now your money is invested there. Insurance is a cost, inventory deterioration is a cost, obsolescence is a cost, damage and pilferage is a cost, warehouse upkeep is a cost, stores labor is a cost, so that again you have to pay stores labor. Next, we look into ordering cost. What happens in ordering cost? When we talk about ordering cost, what comes under ordering cost? Ordering cost is basically firstly preparing the purchase order. For that, if you have some team you have to pay their salaries. Then processing the purchasing documents. Okay. If you have a Okay. Next, we have your administrative cost. Purchasing, here we are processing the purchase documents. In administrative cost, we are purchasing that we are looking into the documents here. एक minute. Yeah. So when we look into ordering cost here, in ordering cost, we have the preparing the purchase orders, you need someone, administrative processing the purchase documents, you need a person, transportation cost, logistics for bringing the order to your go down, you need someone, right? So if you have more orders, your inventory cost, ordering cost goes high. More the orders, more the ordering cost. More the order, more the ordering cost. Okay, more the order, more the ordering cost. Then we have your stock out cost. Now, what is stock out cost? Now, someone came to your shop, you don't have any good, you lost the sale, you will buy from somewhere else. Next, you will lose some goodwill also. Next time also, he will not come. Next, production stoppage. Your factory waits for raw materials. Your factory will wait for the raw material, right? The production will also be stopped. Emergency order, high transport and purchase costs. Now, if suddenly if you need last minute में अगर हम लोग को चाहिए, last minute we need the goods, last minute we need the goods, then again there's a problem. Last minute we need the goods, then also there's a problem. Then they will charge higher. We will pay whatever somehow we will just so that we can deliver the goods. If you don't have better planning, then last minute you will order something you will do in the last minute. That doesn't always really help. In the last minute you might do something that doesn't always really help. Okay. Doesn't really always help. Next we have inventory recording cost. So the cost of maintaining the inventory management software, store administration. For recording inventory also we have to pay, right? For recording inventory also it is expensive. Yeah. For recording inventory also it is expensive. Even recording inventory is not really easy, right? Again, recording inventory is also not very easy. For that also you need softwares and you have to pay for that. Next, high fixed cost versus variable cost. Warehouse rent is a fixed. Insurance again will be a certain cost. Store space again an opportunity cost. So warehouse rent, insurance and storage space, these are your fixed holding cost, right? The rent will be fixed, insurance premium will be fixed, storage space will be fixed. So that you have to pay your fixed cost. These costs are fixed. Interest on the capital tied up, how much of money you have to invested in your inventory storing. Yeah, and interest on that is a problem, that is also stuck. Inventory on capital tied up is a variable cost increases with inventory held. Your cost will increase with the inventory that you're holding. Cost increases with the inventory held. So if you have too much cost, then also there's a problem. Your cost is increasing with the inventory held. As you hold more and more inventory, your cost will go more and more. And finally, opportunity cost, right? In case of if you're losing sales, again, the more the sales you're losing, the more money that you will be losing. That is, certain elements are variable, certain are holding. Rent, insurance, storage is your fixed cost. Interest cost increases with inventory, and opportunity cost is your variable cost. So that are certain costs that are fixed, certain costs that are variable. Now we look into the formula of each. Holding cost. Holding cost we take is holding cost per unit, that is CH, into quantity by 2. Now why do we do quantity by 2? Because if you have inventory, you're not going to hold all the inventory all the time. Because some you will you'll send to the factory, some will come back from the factory. So all the time the entire inventory will not be in the floor of your godown. All the time the inventory will not be there in the floor of your godown. All the time the inventory will not be there in the floor of your godown. All the time the inventory will not be there in the floor of your godown. Okay, so it's very important that you only take the average inventory. Average inventory is Q by 2. Okay, your average inventory is Q by 2. So what you do, first you take the holding cost per unit, that is CH. Then you take the order quantity Q, and then you divided it by 2. You take average inventory. Right, so you take the holding cost, you take the order quantity, and you take the average, you divided it by 2. Why do you do this? Because inventory all the time is not there in your godown, right? Inventory is moving from the production department, production stores, it's moving up and down all the time. You will not find all the inventory throughout the year just kept. You didn't buy it for that, you buy it to actually use it. So you take only the average inventory. So Q by 2 into the holding cost per unit. Q by 2 into holding cost per unit. You take Q by 2 into the holding cost per unit. Q by 2 into holding cost per unit. Okay, Q by 2 into holding cost per unit. Q by 2 into the holding cost per unit. Next, you have your ordering cost. What about the ordering cost? Ordering cost is ordering cost into D by Q. Ordering cost into D by Q. Now, the cost of one order into D by Q. Cost of one order into D by Q. right? Your cost of one order into D by Q. What is the cost of your one order into D by Q? Then what is D by Q? Annual demand is, let's assume 10,000 is your annual, 12,000 is your annual demand, right? And every month you place an order of 1,000 goods. So how many orders you have to place in 1 year? 12 orders. Cost of one order is 500 rupees. Once again, your annual demand is 12,000. Annually, you need 12,000. How many orders? How do you place the order? Thousand, 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 thousand. So 12,000 divided by 1,000. Each time the quantity that you place in order is of 1,000. So how many orders do you place in 1 year? How many orders do you place in 1 year? Okay, how many orders do you place in 1 year? You place 12 orders, and per order you are paying 500 rupees. Okay, 500 rupees per order. So 6,000 is your ordering cost. So your annual demand divided by the number of orders per order. Sorry, number of units per order. So in 1 year, you need 12,000 units. Each time you order 1,000 units. That means 12 is the number of orders you make in a year. 12 you make in a year. What happens in 1 month? To what 12 you make in a year? What is the total ordering cost? One order is 500 rupees. 12 orders is 6,000 rupees you're paying ordering cost. 600 is your ordering cost. It's like your delivery cost in Swiggy and Zomato. You need 5 biryanis, but you need it for at 5 different times of the day. So you don't buy it at once, you place 5 separate orders. So 5 separate orders, 5 separate delivery charge you have to pay. 5 separate orders, you have to give 5 separate delivery charge. 5 separate orders, you'll have to give 5 separate delivery charges. So it is the number of orders you make, more will be your ordering cost. It's like your delivery charge. The number of orders you place, more you will pay delivery charge. If one order only you order everything, less delivery charge. Right? So it will be less delivery charge. One time only you order everything, less delivery charge. More times you order, more delivery charge. Then you take the annual cost. Annual cost, you take ordering cost, holding cost, and the purchase price per unit. Right? How much do you purchase? Right? 12,000 I purchase at the price of 1 rupee. Per product is 1 rupee. So 12,000 is the purchase price, total ordering cost, total holding cost. If you add everything, you will get total annual cost. Purchase price per unit, total ordering cost, total holding cost, and you multiply everything, you will get your total annual cost. Like you take your total purchase price into annual demand. That is your total purchasing. How much did it cost you? Plus you ordered it. How much did it cost? Holding it. Now you're storing it. How much did it cost? You add everything. You will get total annual cost. So first we looked into ordering holding cost, where you take average inventory. Then we took ordering cost, and then finally we took total annual cost. So holding cost plus ordering cost plus annual cost. Okay, holding cost plus ordering cost plus annual cost. If you add all the three, holding cost plus ordering cost plus annual cost. If you add all the three, holding cost plus ordering cost plus annual cost. You add all the three. Sorry, holding cost, annual, holding cost, ordering cost, and purchase cost. You add all the three, you will get your annual cost. So holding cost, per ordering cost, and purchase cost. You add all the three, you will get your total annual cost. So annual cost is just the addition of the three. Purchase price into demand plus your ordering cost plus your holding cost plus your holding cost. So that is pretty much about the total annual cost. So I purchased 12,000 units. So the purchase price into 12,000, purchase into demand, plus now I have to order them also. So total ordering cost plus now I have to hold them also, total holding cost. You add all the them, you will get total annual cost. Okay, price into demand and total ordering cost, total holding cost. You will get your total annual cost. So this is how it works. First you take purchase price and demand, then you to that you will add total ordering cost, you will add to that total holding cost, you will add, and that will give you total annual cost. Okay, that will give you your total annual cost. So you order, you hold, and you purchase. That will give you your total annual cost. Next we look into is buffer inventory. Extra inventory. Buffer means extra. Buffer means extra. You keep something extra. Sometimes unexpected demand can happen. It is good to have extra. Then supplier delays. Sometimes the supplier is delaying. You don't want the production to stop. So you always keep little extra. Machine will break down. So customer's order still you have to fulfill it, right? You can't say my machine broke down. So it's always good to have something already produced and kept extra. Next, reduce emergency purchases. Because see, if you do emergency purchases, it can be very expensive. Emergency purchases can be very expensive. Okay, so it is better to have certain extra always kept with you. Next, cost of buffer inventory. So even buffer inventory is also not free because your money gets tied up. You have an insurance. You have to do storage, right? It can get damaged and there can be risk of obsolescence. Firstly, your capital is tied up, right? Second, there is insurance. Third, there is storage. Fourth, either there can be damage or theft. And fifth, there is obsolescence. So these are all the cost of buffer inventory. One, your capital is tied up. Second, insurance. Third, there is some storage issue. Next, damage and theft. And finally, obsolescence, right? Your capital is tied up. Insurance, storage, damage or theft, and obsolescence. All these are your cost of buffer inventory. Either your capital is tied up, either you have to pay for insurance, you have to pay for storage, you can pay for damage or theft, and then obsolescence. Inventory may become unsellable. These are the cost of buffer inventory. These are the cost of buffer inventory. Your capital is tied up. Insurance, storage, damage or theft, and obsolescence. Capital is tied up. Insurance, storage, damage or theft, and obsolescence. Okay, that is the inventory may become unsellable. The capital is tied up. Insurance, storage, damage or theft, and obsolescence. The capital tied up, we understood that capital is tied up. Insurance, extra inventory, you will need insurance. Storage, more warehouse space. Damage and theft, higher risk. Obsolescence, inventory may become unsellable. Obsolescence, inventory may become unsellable. And obsolescence, inventory may become unsellable. In obsolescence, your inventory may become unsellable. Okay, inventory may become unsellable. Obsolescence, your inventory becomes unsellable. Damage or theft is higher risk. Storage, more warehouse space. Insurance, extra inventory needs insurance. If you have extra inventory, you need extra insurance. Your money is tied up also. If you buy extra goods and if you keep extra goods, your money is tied up. If you buy extra goods, keep extra goods, your money is tied up. You need money for insurance. You need money for storage. Your goods can get damaged. There can be theft. Right? Your goods can get obsolescence. So even if extra inventory also is a problem. Keeping extra inventory is also a problem. Right? Just having extra inventory also is a big problem because money is tied up. Even if you buy extra inventory, your money is also tied up. Even if you have extra inventory, your money is also tied up. Now, coming to low inventory cost, high inventory cost. Let's look into that. If you hold too much inventory, what are the cost? If you hold too less inventory, what is the cost? Too much inventory, what is the cost? Too less inventory, what is the cost? The first we look into, if you have too less inventory, what is the problem? If you have too less inventory, then you will have lower holding cost. So for sure, because you're keeping low inventory, but your ordering cost will go high. You'll have to order again and again and again throughout the year. Then you have a risk of stockouts. The customer will come, you will not have the goods. There can be production delays also. There can be delay in production. There can be lost sales. Sales will be lost. And there can be emergency purchases. Right? There can be emergency purchases. So these are the low inventory. Lower holding cost, higher ordering cost. There'll be a risk of stockouts, production delays, lost sales and emergency purchases. Lost sales and even emergency purchases. The one is low holding cost, one is high ordering cost, risk of stockouts. There can be production delays, lost sales. Sales are also lost, and emergency purchases. And there can be emergency purchases. That is all low inventory. Low holding, high ordering, risk of stockout, production delays, lost sales, and emergency purchases. Yeah, emergency purchases. Next, high inventory. What about the high inventory? There is higher holding cost. There are higher holding cost. If you have high inventory, there is high holding cost. In case of high inventory, there is high holding cost. There is low ordering cost. If your inventory is high, holding cost will be high. Why? Because you have a lot of goods. You have to hold all of it. Low ordering cost. Right? Your ordering cost will go low because you have ordered a lot in one goods only. You're keeping a lot with you. So you won't need regularly inventory. Next, there's a less risk of stockouts. There's a less risk of stockouts. Right? There is a less risk of stockouts. Next, there is a smooth production. There is a smooth production because you have a lot of inventory. Capital is tied up. A lot of capital is tied up because you have purchased so much inventory. And next, obsolescence risk. Next is obsolescence risk. There's a risk that it might get obsolete. There's a risk that your inventory might get obsolete. There's a risk that your inventory might get obsolete. Lot of capital is tied up. You're going through a smooth production. There's a less risk of stock out. There's a lower ordering cost. There is a higher holding cost. There's a lower ordering cost. There is a higher holding cost. So that is about low inventory and high inventory. High holding cost, low ordering cost. Less risk of stock out, smooth production. Lot of capital will be tied up and it can get obsolete. If you're unable to sell it, it will get obsolete. If you're unable to sell it, it will get obsolete. Okay, next we look into inventory trade-off. What about inventory trade-off? If your inventory is low, holding cost is low because you have low inventory, but high ordering cost. If the risk of stock out is high, customer satisfaction will be low. But if you have high inventory, holding cost is high, ordering cost is low, stock out risk is low, customer satisfaction is high because immediately they will get the customers. So even low inventory has its own problems, high inventory also has its own problems. Right? Low inventory also has its problem, high inventory also has its problems. Both have its issues, and you have to try to find an optimal inventory level. Right? What you have to do is try to find an optimal inventory level. What you should try to do is find an optimal inventory level, not too much, not too less. An optimal inventory level that will help you a lot in the long run, having an optimal inventory level. Okay, at this point, we'll look into a numerical here quickly. A company uses 6,000. So this is your annual demand. So 6,000 is your demand in 1 year. Okay, 600 units a year, which can be bought at 1.20. This is your total purchase cost. Right, 6,000 units at 1.20, you will get your purchase cost. Right, this is your purchase cost per unit. This is your purchase cost. Next, but here they are not asking TAC. They're not asking total annual cost. They are just asking ordering and holding cost. So the company orders 1,000 each time. So 1 year you need 6,000. You order 1,000 each time. So you place 6 orders in a year. In 1 year you will place 6 orders, and the cost of each order is 20 rupees or $20. So 120 is your ordering cost. Annual demand is 6,000. Each time you place 1,000 orders. So you're placing 6 orders in a year, and one order is $20. So totally $120. Total ordering cost is $120. Total ordering cost is $120. Total ordering cost is $120. Next, holding cost. So what is your average inventory? So average inventory is Q by 2. So here you have your order size 1000 by 2. Average inventory is 500. Always take average inventory, because see, go down in the go down, all the goods are not present all the time in the go down. You will keep moving up and down, up and down, up and down. Factory to supply store, factory, supply store, factory, supply store. So all the time you'll not be holding all the inventory. So you take an average inventory 500 units. That is 1000 by 2. And they are telling which are bought in 1.20. Average inventory already they have given, but we can calculate. Total holding cost is 20% per annum. So you have to take your purchase price 20%. Right? The total holding cost is 20% per annum of the average inventory held. So purchase is 20% of the average inventory. So first you calculate average inventory into 1.20. So this is the total value of the average inventory into 20%. Then only you will get your holding cost. So it is 20% of the average inventory held. So average inventory held is 500 units, but you don't want cost in units. You want it in dollars. So the cost of per unit in 1.20. So you take 20% of the average inventory. So two things are here. 20% of the average inventory. 20% as it is, take 20%. Average inventory you do 500 into 1.2. Average inventory you do 500 into 1.2. Average inventory what you should do 500 into 1.2. 500 into 1.2 is an average inventory into 20%. 500 into 1.2 is average inventory into 20%. 500 into 1.2 is average inventory into 20% you do. That is 120. 500 into average inventory into 20%. So you will get your 120. 500 into average inventory 1.20 into 20%. 500 into average the price per unit, you will get average inventory and 20% of that. So you will be getting your total holding cost. Okay, so this is how you get your ordering cost and your holding cost, straightforward. Okay, next we'll look into here TYU1. Ordering cost is there. Has recorded the following components 427, which is sold in boxes of 10 components. So ordering cost per order 32 you will pay. Purchase price 20 per box of 10 components. So it's basically $2 per component. Holding cost 10% of purchase price. And your monthly demand is 1500. So yearly demand will be 1500 into 12, 18,000. So you got your annual demand also. Components 427 is currently ordered in a box of 240 at a time. The average inventory is 120 boxes. The annual holding cost. So what are they asking? Annual holding cost, annual ordering cost. Same two things they are asking. For holding cost, what do you need? And for ordering cost, what do you need? So first you look into for how many? For component 427. Okay, so we look into this here. So component 427 is the name of the component. Okay. So component 427 is the name of the component here. Okay, so component 427 is currently ordered in batches of 240 boxes. At a time, 240 boxes will be there. Average inventory also they have given. Right, almost everything is given over here. Okay, average inventory is also given. Right, so we have our average inventory also is 120 boxes. So again, holding cost is your average inventory into the price per unit, which is your 20, the $2 or 20 on terms of boxes if you're looking into. So $20 is per box into your holding cost percentage, 10% of the purchase price. Holding cost straightforward, literally the same way. If you look at average inventory was 500 units, here average inventory is 120 boxes. Then into the cost per box, we have the cost per box 20 into 20%. In this case, it is 10%. So annual holding cost is done straightforward here. Annual holding cost, straightforward annual holding cost. Then we have annual ordering cost. How do you need? You need annual usage. 18,000 is your annual usage. How do you know? 1,500 is monthly into 12, 18,000. 18,000 is annual. Okay. Now coming to each time, how many boxes are you placing? Next, you're coming to what is your order size? Each time you're placing an order, what is your order size? Currently ordered in batches of 220, 240 boxes at a time. Right? Each order is 240 boxes. So you have your 18,000 by 240, you will get number of orders. Number of orders into 32. Number of orders into 32. Just try to do it through this sum. Annual usage 6,000, your annual usage 18,000. Each time order 1,000, each time order 240. Ordering cost 20, ordering cost 32. That's it. Annual holding cost 500 units average inventory, your average inventory given 120 boxes. Cost per unit is 120, cost per box is here 20. What is multiply that and into 20% here into 10%. हाँ हाँ, पर कंपोनेंट लेवल पे निकालना है तो $2 है, अगर आपको बॉक्स लेवल पे निकालना है तो $20 है। तो यहाँ पे कंपोनेंट लेवल, हाँ करेक्ट, तो आना दोनों चाहिए, इसलिए मैं दोनों बता देता हूँ क्योंकि एग्जाम में, हाँ 20 ले लेते, अगर बॉक्स लेवल पे पूछा होता तो इधर याद, क्योंकि आप फाइनल वापस से कंफर्म कर लिया है, कंपोनेंट लेवल पे पूछा है तो आपको उसके हिसाब से लेना है। ठीक है, सो दैट इज अबाउट दिस, डन। ओके, so this is your TYU1. Next we have our EBQ and certain topics on reorder level. So first let's look into the reorder level. What do we have with maximum minimum inventory and our reorder. Here, reorder level. So next we look into here the system of inventory control. How we look into the inventory control. Next we look into the graphical representation. So reorder level basically means that how much should be your inventory when you're reordering. Okay, when you reorder something, how much should be your inventory? Okay, we'll just keep it in the same sequence. So when you're reordering your inventory, how much should be your, when you're reordering, how much should be your inventory? When you're reordering, how much should be your inventory? So this is your reorder. That whenever I place a new order with a supplier, how much should be there already with me? Whenever I place a new order with the supplier, how much should be there with me? Whenever I'm placing a new order with the supplier, how much should be there with me? That is your reorder level. So what is reorder level? Reorder level is the quantity of inventory in hand when you place a new order. That how much should be in your hand? How much should be in your hand when you place when you place the a new order with the supplier? How much should be in hand when you place a new order with the supplier? How much should be in hand when you place a new order with the supplier? In your hand, how much should be there? That is called reorder level. How much should be there in hand when you place a new order with the supplier? Whenever you place a new order with the supplier, how much should be there in hand? That is called reorder level. How much should be there in hand when you place a new order with the supplier? That is reorder level. So it is how do you find the new order level? It's the maximum lead time into the maximum usage. Lead time is how long it will take once you place the order, how long for it to come back to you. How long it will take for it to come back to you. That is maximum lead time. And maximum usage is basically about the maximum you will use during that lead time. Right? What is your maximum usage versus your maximum lead time? So a company uses components at the rate of 1,500 per week. So per week is how much you're using. The time between placing the order is 5 weeks and the reorder quantity is 12,000. Right? So right now you don't really need your reorder quantity. It's an extra information. But what you really need to understand is what should be a reorder level. Reorder quantities, when you place a reorder, how much quantities are you asking for? That is 12,000, irrelevant at this point. So if you want to calculate the reorder level, you have to just see how much do you need per week? 1,500. And how much it will take maximum to come back? 5 weeks. So the moment your goods at 7,500, immediately you should place a new order. Whenever your goods are at 7,500, immediately place a new order. Whenever your goods are at 7,500, immediately place a new order. Okay. Whenever your goods are at 7,500, immediately place a new order. Very important. Immediately place a New order. Whenever your goods are at 7,500, place a new order. That's it. And so that is your reorder level. So here, 1,500 you need per week. How many weeks it takes to come back? 5 weeks it needs to. Minimum, the moment your minimum inventory or your inventory value is 7,500, immediately place the next order. Because by the time it comes, this will get over. Because by the time it comes, this will get over. Okay, by the time it comes, this will get over. Very important that you look into how much time it's taking, because by the time it comes, this will get over.